Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Hi everyone, it's 4:30. This is John Moss from ISC, and we're going to start the webinar, Top 3 Methods to Determine Market Reversals. Andrew should be on the line. I just want to make sure he has audio access. So Andrew, can you say hi?
Hey John, can you hear me okay?
Yep, I hear you loud and clear. So just to tell you a little bit about Andrew, he's the portfolio manager and editor of ETFtrader.com, and that's spelled ETFTradr.com, and that's part of the Big Trends Trading Network. ETF Trader delivers professionally managed suites of ETF trading services, including an options newsletter, investing newsletter, and a training course called ETF Elements, the Science of ETF Trading. Andrew draws on more than 5 years of experience as a professional trader and a lifetime of active involvement in personal trading to develop and manage effective ETF trading systems. So with that, I want to hand this off to Andrew and let him run the webinar.
Hey, thanks a lot, John. I'm assuming if you can't hear me okay, you can always adjust. I know that sometimes if it's between John or I, our microphones may be a little bit different. So if I'm not as loud as John or too loud, you can adjust your own volume. And of course, if you have any other problems, just let me know via the chat. Throughout today, I will certainly answer any questions you have about what I'm talking about. So please ask questions, and I would love to interact with you. So looking here to have some fun today. Obviously, I want to talk about something. It's going to be more on the basic side from what we do here at BigTrends.com on a regular basis. We're going to talk about how we determine market reversals. So not typical things that we would use on individual stocks or even many ETFs. Obviously, all of this is going to be pretty helpful for trading ETFs like the Qs or the DIA, IWM, or the SPY, of course. So we want to focus mainly on that, just your broad market averages, if you will. But before we get into that, we just want to quickly tell you a little bit more about Big Trends and who we are. We've got 5 analysts, including our CEO, Price Healy, and between us all, we have over 50 years of market experience. We do focus mainly on options and technical analysis. We have thousands of traders worldwide since 1999 that we have helped out. We've guided and educated on trading, again, mainly options and trading options on stocks and ETFs. We do have a track record of success. If you have any questions about anything that we do throughout today, feel free to just chat me on here on the platform, and I'd be more than willing to give you more information or help you out. You've probably seen us around, obviously, on ISC webinars. This is probably my 3rd ISC webinar. Price Healy has been on these webinars as well, and you've obviously seen us around on different trading platforms around the web and in the news. Okay, so this is going to be pretty basic starting out. I definitely don't want to leave some of the folks that are beginner traders or maybe haven't really looked at the market from the perspective that we do in the dust, per se. I'd like to really cover it from A to Z. And, you know, when it comes to anything trading-wise, from my personal point of view all the way up to our professional point of view, is that everything needs to be as systematic as possible. And that's why, you know, it's ironic, but that's why I love coming to the ISC and doing webinars with them, is because they're really pioneers in this systematic trading about the 100% electronic. And, you know, there's certainly a lot of bad connotations to that potentially, but when in fact you look at bottom lines for both professional and large-scale trading, all the way down to your trading in front of your desk on your own, whether you're in Florida, New York, or California, whatever you're doing, being systematic is going to yield to the most consistently profitable situations, and that's clearly where you want to be. I mean, for me, it's consistency in trading is really the most important. So how do you get there, and how do you really systematize a short-term market timing, or at least looking for reversals, i.e. looking for those inflection points in the market. That's what I want to help you do today by breaking it down in 3 different ways. I'd like to show you really more tangible ways of looking at well-known market indicators and really adapting those to something that you can use starting tomorrow. So first off, we're going to take a look at sentiment, and we're going to look obviously at the ISE index, which is a call-put ratio. We're going to look at the VIX, which is obviously the CBOE volatility index, and also the CBOE's ISE index, which is its partner, which is the EPCR, or the equity put call ratio. And Ray says, yeah, I'm not still on the intro slide. I'm now on slide, oh, I don't know, this is the 3rd or 4th slide, or the 4th slide. I'm assuming everyone here is on the 4th slide.
Okay, I'm on the 4th slide here, yeah.
Okay, great.
This is John, sorry.
Yeah. Yeah, I think everyone's on the same page here. At any rate, these 3 components are the 3 market timing things that we want to look at. And Sukhdev Kapoor has a good question. Is the VIX and the VXX the same thing? The VXX is actually the ETN, I believe, the exchange traded note for the VIX, and it's supposed to track it, but there are some nuances in its and how it's accounted for. So there are some differences, but basically, yes, it's supposed to be tracking the main volatility index, Sukhdev. So anyway, the sentiment index is the equity put call ratio and the ISE equity call put ratio. We're going to get into that. That's something very important to know the difference between. Secondly, we're going to look at trend-based reversals and how to help you with that. In the end here, keep in mind we're going to give you more or less a systemized way that's complete and well-rounded to tackle and try to find these market reversals. The trend analysis will be based around %R, and it's a method that we developed here at Big Trends. It modifies %R a little bit, and I'll be more than willing to share that with you so that you understand that. And then finally, just simple. I mean, keep it short and simple and round it out at the beginning with support and resistance. Ways to really show you where, hey, this is probably not a good situation if number 1 and number 2, sentiment and trend analysis are pointing towards one thing, and so is support and resistance. Well, then you definitely will start to see some very high probability market reversals happen. The time frame that I want to focus on today mainly is going to be daily. Many of these indicators, specifically the sentiment indicators, are built on daily. So that's clearly why I want to take a look at it. That doesn't mean that you wouldn't be able to, let's say, figure there's going to be a reversal here in the next day or 2 based on these systems that I'll show you, that you couldn't just go drill down to the hourly chart or the 15-minute chart and then determine a option strategy on that you may want to do. So it'll clearly be profitable for you to learn this even if you're an intraday trader. If you're a weekly trader, obviously it's going to help, but those longer-term traders may not be as really may not be as helpful to know what's going on today if you're looking at, and I've talked to like more and more people are looking at the weekly and monthly charts more often. This is going to be a little bit more active than that. But going forward here, from the sentiment side, there's 3 things that we take a look at on a regular basis. And what I want to do is give you thresholds for you to take a look at. So number 1, how do you measure sentiment extremes? In other words, there's 3 main ways that we look at it. The ISE equity call put ratio, which you see a picture of down there below, which you can obviously get on the ISE's website. We go there every single day. We manually pull down the data and manage it in one of our own platforms. So it's not quite, there's several different ways that the IC has made it very easy to obtain this. So definitely do not overlook it because it is there. But again, the CBOE equity put call ratio and the ISC sentiment index are both looking at calls and puts, right? What's important about both of these is that each of them, CBOE and ISC, give you several different channels of call put volume, where you're looking at, for example, the ISC has all ETFs and stocks, or equities and ETFs. So we remove the ETFs specifically, and the reason why is because And I don't believe, I think the original reason why we did this at Big Trends was because we weren't really sure if they were incorporating inverse ETFs in there. So calls on an inverse ETF would clearly be sending you mixed messages in that calculation. I believe the ISE does not include those in there. At one point in time, I had contacted the folks over there, and I believe they confirmed they do not consider inverse ETFs in the ISE index. That still being said, we want to keep it straight equities because that's what the CBOE equity per call ratio is. So we have a look at each one. The equity per call ratio is the same thing. It takes a look at calls and puts. Again, there are some differences in the ISE. I believe just looks at opening trades and some other information. But the main difference that you'll see from the raw data is that the ISE is a put and the CBOEs is a put call. And I'll show you a picture here of what we do to basically you just make those one of those inverse so that they're both the same. In the end, both of these will give you some great information on options trading every day. Very, very important for timing. Why? Because it gives you some cold, hard sentiment data of raw traders that really have a feeling on the market or they have sentiment on the market and they're going to go put money at that. Well, we know over time that the majority or the majority of the volume traded is typically going to be on the wrong side of the trade for short-term trades. So what you'll see is just your classic fear and greed displayed in the call put or put call ratios. When they get to an extreme level, it's either complacency or fear, depending upon if it's bullish or bearish, and it can get too extreme. And the way we measure that is with Bollinger Bands. I'll show you here in just a second. Also, the volatility index, clearly everyone knows what that is. That's the VIX. What we want to do is just show you an objective way to measure that. So number one, here we've got the ISE and the CBOE equity only put call ratios. So only stocks, nothing else. What this gives us is the total number of calls traded divided by the total number of puts, or total number of puts traded divided by the total number of calls traded. So what we'll get is obviously there's a very strong bullish lean on the market. So you're almost always going to have a number under one, unless there's only been, I would say, it's been a while since we've seen a reading over one on the put call ratio, because it is just obviously very hard to get there, and we haven't been in any extreme fear recently. But regardless, there are typical, and if you look this up online, if you're interested in finding out more, but what you'll see typically is that a lot of people will draw straight lines, and they'll say, well, anytime that the equity put call ratio goes over this line, or the ISE call put ratio goes above this line, it's a buy or sell signal. So in the end, what is that? Well, we know that fear and greed and the market fluctuations are very, very, very relative to their time sensitive, right? So there isn't just you can say that a 1 and anything below, let's say a 35 is 35% would be really, really low. But take it a step further and make it very, very accurate to the time. The way we do that is with obviously Bollinger Bands, 20-day standard deviation Bollinger Bands will give us what's expected to be 96% of the price action. So in the end, what we know is that when it goes outside of these bands on the upper side, what does that mean? You got nearing 1, that's a fear spike, right? Because you're getting way more puts than calls. You're not getting way more, but relative to it. So if it reaches that 1, and it's definitely, I've seen it up as high as 1.35, which is just very dramatic, 135%. But and that was back in 08 or around there at that point in time. But that means that we have literally reached so much fear, and you can almost put it in tandem. I guarantee you'll also see, things on the front page of the newspaper is going to say something about the market. It basically objectifies these very difficult subjective things about the market. When you start to see, when your neighbor starts to tell you to buy gold, that's when you should sell your gold, because it's oversaturated and you don't need to get in anymore. Well, this helps you measure that on a very short-term basis in the market. Now, this is this isn't up to date from today, but you can see here it's a good example, is why I picked it. You can see here that the ISE goes outside of its bands not all that often. So again, remember, these would be buy points, just a simple spike below. When you got below, now the CBOE is not doing that up there, which is interesting. We take a look at both of these, and we've been taking a look at both of them, I believe, since about 07. The IC had been out for a little bit before that, and it took us some time. The CBOE has been out longer, obviously. So we are still watching these on a regular basis. But the idea here is that these would be fear points that you would buy. And I said this wrong earlier, I'm sorry. Fear points would be above, right? Fear point you would buy here because you've reached extreme fear. So palpable that it's a flush out, right? The flush out that you'll get. Now, are these 100% accurate? Obviously not. You can see here where you get a very small spike out right here, and it's a great short-term buy signal. Again, if you want to drill down to the hourly, you can see this a lot. It happens very good, although we still saw it roll over. So for about the next week, you were doing great. So if you're a short-term trader, certainly look at things like this. These sentiment things, I mean, you almost definitely will see a spike up over the next couple of days. And here we got another one right here where we did not see a spike up. So this isn't going to be obviously 100%, and nothing is 100%, but it's a way for you to systematically approach it and see, okay, well, this has been pretty bullish. This would be a, quote, sell signal. Or, again, we're trying to determine market inflection points today in 3 simple ways. What could this also help you with? These would be points when you would, if this is the complacency down at the bottom, where you reach that. Let's see, like right here, where you've got a spike below on the equity put call ratio from the CBOE and pretty darn close, if not outside, of the ISE. So what do you do there? Do you start methodically taking profits? You certainly do. It's certainly something that you want to look at and want to build into your total trading system or your trading plan. Certain ways to let you know or signal to you, hey, I need to start being a little bit more protective of my profits, and maybe not putting out as many trades, or some way you need to work this into your complete system and not just lead it in there. But it definitely gives you an unbelievably good look on the markets on a short-term basis. Coupled with this, from a sentiment standpoint, would obviously be the VIX. And this is just obviously an illustration of the Bollinger Bands at use again. I would recommend, again, 20-day 2 standard deviation, pretty standard there. Nothing crazy, but what would you be looking for on this? From a systematic standpoint, to put a more tangibleness on it, you would be looking for 2 consecutive closes outside the Bollinger Bands to signal an extreme. So you see here where we don't really get this over the last, this is again about a year old of a chart from last summer, because it was a good example. But you can see here where, boom, you had 2 consecutive closes outside. Here you have 2 consecutive closes. And of course, when you see that volatility go up, well, the market's typically going down. When that, followed by that volatility implosion, is a market rally. So these are 2 great buy points. Another short-term great buy point, and really longer term, because it continued to go down, although there was a spike right here. So dependent upon, and each of you will probably use this a little bit differently, depending again on your time frame that you typically trade. But an illustration to show you, showing you all my cards, in some very unique situations like we've had over the last couple of years, sometimes, as you take a look here, we had 2 consecutive closes, and then it bounced back that following day. But it was clearly nowhere near the massive sell-off that we had. That's obviously going into the flash crash, which was obviously an aberration. And when you would see something like that at any point, it still gives you access to see how something like a Bollinger Band adapts to such a major move. Even then, you can see the final flush out, which this was a pretty ridiculously flush out right here. But in the end, the final one, and by the way, if you were doing this systematically, what would you do? You'd have two consecutive closes right here. Right here, you would be basically continuing to buy, or continuing to what? Close out your short or bearish positions. So let's say that you have an hourly system where you look at stocks and you broke into a couple of bearish positions right around in here. When would you start to lighten up on some of those, or potentially not looking for any new ones? When you started to see these bearish extremes being reached, because we're coming closer to a market reversal. And one of these is it's going to be, and you can see going back here, reversal, reversal, reversal. On the downside, in a bullish market, think about it. Think about how bullish the market was for all of this time. We never received, and this is very crucial to understand, we never received two closes below the lower Bollinger Band in all of this time. And think about what the market was doing from late 2009 to early 2010. It was very, very bullish. So it was very strong, and obviously we never got something to say, lighten up on your bullish positions or anything like that until the closest we got, ironically, but we didn't get it, would have been right here, where you see that one little candle close right below there, but it's just one. And then you had over here as well. But we never got it. So, is it going to be 100% perfect? Obviously not. But from a systematic standpoint, look for two closes above or below, depending upon what direction it's going to be happening in, the Bollinger Bands. Okay. So if that's the sentiment standpoint from it, remember we're looking for Bollingers around the daily readings of the ISE, which you can get from the ISE's website or the CBOE's website. We track both of them. You were looking for spikes above or below to signify measured fear or greed. And the same thing with the VIX. You're looking for two, not just one, two consecutive closes outside those bands. And that would give you a time to, number one, start looking for trades on that side of the market that's supportive of. If it's supportive of a bearish reversal, you start looking for bear trades. If it's supportive, or if it's supportive of a reversal to go back higher, you might start to, number one, lightening up on your bearish allocation or your bearish exposure, and then also start looking for bullish. What's important though, and I really like to focus on the sentiment standpoint of letting it help me reduce my exposure to the side that looks like it's starting to end. I don't want to place new trades until I get to a trend that has confirmed that I like. So basically, you use the sentiment to help you lighten up on positions of when those trends are looking to be exhausted. And then now we're going to move into the trend-based part of this, which will be very, very helpful for, really it'll be helpful for stock trading as well. This is the one part that obviously we use this on stocks and ETFs as individually. So at any rate, to get started with that, number one, you want to, if you're looking at the broad market and trying to time that, well, what are you going to look at? You're going to look at the S&P 500, the index, you're going to look at the Dow Jones. What are you going to look at? Well, you want to specify what this is, and the reason why is because the way that we set up our systems is it's down to the penny on telling you what to do. Now, if you're really right there around a penny on a confirmation, which I'll show you here in a second, well, you might find yourself looking back at the SPX versus the SPY, and one may confirm and one may not if it's that close. So then you'll find yourself fighting over what to do. Are we going to be bullish or bearish today? And that's why I want you to choose an asset. Some people do not like the S&P 500 compared to the actual index. I'll leave that up to you. I use the SPY. Obviously, I think it's a very well-run ETF, and there's a little bit of difference from here and there, but there's really nothing there to be to be a negative. At any rate, you can use your own, the actual index or whatever you like. Now, the indicators that you want to use to actually time this is very important. I mean, typically you would want to figure that out yourself, but I'm going to provide that to you today. I'll be teaching you something based on Williams percent R and parabolic stop and reversals. And what this will do is give you a very clean and objective way, basically never leave yourself questioning what the chart is telling you, way to measure if the market is bullish, bearish, or neutral, period. Now, that's the system that we'll be developing. And then finally, I just want to make sure that I get this across to you. Everything that we're talking to you about today is to help you create and follow rules and consistently make profits. One thing that we want to almost 100% move at every single level that we can gain access to in your brain is to help you remove those gut feelings. Gut feelings aren't going to lead to consistent profits. They'll lead to more volatile. Sometimes it'll be helpful. Sometimes it'll be devastating to your account. So you want to just avoid trading on those gut feelings.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.